Are you guys seeing it in the, I think you're seeing it the wrong way, hang on. There, are you guys seeing the full PowerPoint? Okay.
Yeah, I can see it.
Perfect. Okay. So basically chapter 3 starts talking about the income statement. All right. And with the income statement, we're dealing only with revenue and expenses. If you remember that from last week, the income statement is revenue and expenses. The balance sheet has the assets equal liabilities plus stockholders' equity. And one of the big things we're going to talk about is not only what's on the income statement, the titles, but how do we put things on the income statement. And we have this operating cycle that's really important. And if you can think even about the world that we're living in right now, how important it is the fact that when you have merchandisers that we're buying goods, we turn around, we then have to pay for the goods, sell the goods, collect the money in order to buy the goods. So if anything ever happens in that supply chain, we have a problem. So think of it this way right now. A lot of things that's happening in the supply chain is, number one, when people originally bought these goods before the world fell apart, right? They have a whole bunch of these goods sitting there. They didn't and weren't able to turn around and sell them. So therefore, they couldn't pay, right? So if they can't sell the goods, they can't collect the goods, they can't pay for the goods. So when this circle gets broken, we then have a problem. If they can sell a little of the goods, they can collect a little of the money, they can pay a little of the people. So over the past 60 some days, we've seen a lot of businesses try to figure out a way to make money doing things they weren't necessarily doing before. The government stepped in, done some loans, different type things like that. Different neighborhoods, depending on where you live. We've had different food trucks come in. We've never had a food truck come in our subdivision ever. And now we have Hacienda, we've had the Smoothie King, we've had the slushy, I can't remember the name of the slushy guy, but the slushy guy's been in our subdivision. So companies are trying to figure out different ways of making money so that they can continue this cycle that has to keep going for companies to operate. Right? They just announced today that TGI Friday might be one of the next companies that suffers completely. They announced they're going to close 20% of their restaurants nationwide. Why? Well, think about it. They haven't been able to get anybody in the store, and I know a lot of people, us included, when we were getting takeout, we were not getting it from big chains. We were typically getting it from local businesses. All right, so this is what our income statement looks like. Remember a couple key points that we talked about last week. The income statement is always listed as for the month only. It's for a period of time. All right. Revenue, sales revenue or service revenue. Sales is from selling an item like a Target. Service is from doing something for the work. All right. You always list your revenues, total them up, and then you get your expenses, listing them all out individually to get our net income. All right. Revenue minus expenses gives you net income. Very easy statement. There's only two things that go on it. All right. And then they'll go through, do the same thing I just did. All right. So, Tiffany mentioned cash-based accounting. All right. We have cash-based accounting is when we record revenues, when we actually receive them, and expenses when we pay them. This is how you and I live. We live in a cash world. Basically, if we have the money, we spend it. All right. If we don't have the money, not counting credit cards, because credit cards in this world that we live in are considered cash. We might not consider them cash, but they are actually considered cash. So in this world, we spend it when we have it, and then we record expenses when we use them up. I mean, literally when we spend the cash. So if I'm going out to eat tonight, I'm spending cash. If I'm getting my paycheck, I'm getting it right now. Cash base is revenue comes in the door when the cash actually comes in. It doesn't matter when I did the work, it's when I get paid. So think about the fact of how you guys get your paycheck. Usually you get paid every 2 weeks or twice a month. So if you're getting paid every 2 weeks, sometimes it's for the last 2 weeks, or sometimes it might be 2 weeks behind. But it doesn't matter to you. You're getting paid on Friday. That's when your cash comes in the door. All right. So if you didn't make any money in month 1, but you had expenses, then technically you'd have a net loss. And then if all the money came in the next month, then you'd have a net income. Okay. Businesses, on the other hand, if they are going to be operating under the SEC, which the SEC stands for the Securities and Exchange Commission, Securities and Exchange Commission, which, if you're going to have stock, you are going to go through the Securities and Exchange Commission, because you can't have stock unless you're listed with the SEC, right? So the revenue and expense recognition principles are what you are governed by. All right, so accrual-based accounting is GAAP. All right, in order to be GAAP, you have to be accrual-based accounting. So you cannot be cash-based. So some companies might not want to sell stock. Some companies might not care if they're a public-based company. They're private. So they might be a cash-based company. They might be a very small company. And as they get bigger and they have more aspirations, they might decide they want to become public, which go ahead and be sold on the SEC. They will have to convert from cash-based to accrual-based. And what that means is, as you can see here, we're going to record revenues when we earn them and expenses when we use them, okay? I'm going to put that word in there, used, all right? So that's accrual-based. Accrual-based is saying revenue when we earn and expenses basically in the same period to which they relate. When do expenses get used? Revenue when we earn, expenses when they are used. All right, so the revenue recognition principle, revenues are recognized when the seller provides the good or service to the person. All right, now this is a little small, and I'm not really care how we look at this from that standpoint, but they go through each one of these steps for allocating the price, figuring out the transaction, all these wonderful things, but it doesn't really matter until you get to step 5, because step 5 is when we recognize the revenue. So this virus has given, unfortunately, the perfect example of why businesses use the accrual-based process. So back in, maybe September, but definitely October, Major League Baseball started selling season tickets for the baseball season. The Cardinals are one of those franchises that sell a huge amount of season tickets, right? So they started selling that in September, October, November, December. They continued for January, February. I'd imagine then they started slowing down. They sold single game tickets in February, all for opening day, and they had group sales and everything going, right? All for an opening day that was in April. Now, keep in mind that if they were a cash-based company, and I'm going to just switch the screen because the next screen is blank to start with so I can write on it. If they were a cash-based company, starting in, I'm going to say October through December of 2019, they would have had, I don't even have a guess, $10 million or more of revenue with very little expenses. Again, going very low, not including salaries. So they could have shown $9 million of net income. Okay, and I realize that's low, just giving me some numbers. And then in 2020, they had January through February, and we're going to stop there, where they had another $4 million of revenue, and maybe they started working on the field a little bit. Maybe they had a couple $1 million of revenue. but they still had $2 million net income. That's cash based. But if I ask you how much money of that season ticket had the Cardinals earned, what would be your answer? Had they earned any of that $14 million I just made up? No. No, absolutely not. So far, if we did this again, October through December, they hadn't earned anything. All right. Now, had they incurred some expenses? Probably. All right. And in their simplified income statement, they would actually probably show a loss. But we all know the Cardinals have lots of other revenue coming in from
advertisers.
Thank you. I was not being able to come up with and sportswear and everything else. So they really wouldn't have a net loss, but in my example, they would. And then over here, same thing. January through February. They had $4 million, so this would be 0. And maybe some of that $2 million. So the expenses that they spent, if they started getting the field ready, were those expenses related to playing? Probably. So maybe those expenses would go down to $1 million. All right. And that's net a loss again. So in accrual-based accounting, look at the difference. Net income looks like $9 million up here. That's an overstated financial statement because now that we're in and they get to April and we are not playing any games, which one is more accurate? The October through the bottom one, exactly. The bottom one. So accrual-based accounting says you don't get to recognize revenue until you actually earn it because you haven't earned it yet. And don't recognize expenses until you use them because until you use an expense, it's actually an asset. So let me show you. And think about right now, this environment we're in has just shown why this has done. I mean, we're getting refunds, my family, for Cardinal tickets, for basketball tickets, for concert tickets, for anything that's going on until God knows when right now. So a lot of things are going on. The Muni's been canceled, all different things. All right, so there are a couple different examples. What was that, Adam?
Oh, never mind.
Okay. Another, I was shocked, and I mean, several of you guys are also at four-year schools. I actually got a refund from my son's school. I was shocked, but I did get a little bit of a refund. Okay, so timing. So the first we got here is you're given a promise. You receive cash, and you're given a promise. The promise is that you are going to be given the Cardinal games. All right? So in that example, it's cash, and we have a new account. It's called deferred revenue. That deferred revenue is a liability. Because until the Cardinals give me a baseball game, they owe me a baseball game. So they got my money, but they didn't give me my game. And then once they give me the game, then deferred revenue becomes revenue. So this first one right here is in this wonderful world we're living in is actually just turning around and becoming deferred revenue cash because the Cardinals are issuing refunds. That doesn't happen in most normal worlds. All right, so deferred revenue is a liability. It is the only liability that we'll talk about in this semester that does not end in the word payable. All right? Now, the next way you could see this is the easiest way, all right? And that way is when you receive cash and you just get to credit revenue. That's walking up to the Cardinal box office and saying, I want a ticket to the game. All right? That's the easiest way, cash and revenue. And then the third way is when you do the work, but you don't get paid. Now, not a lot of great cardinal examples I can give you on this one, but this would be when you go in and do the work and you send an invoice. So this would be accounts receivable and revenue. And then when they pay the invoice, it would be cash and accounts receivable. All right, so again, I don't really see that much in the baseball examples, sporting tickets examples, unless it could possibly be for a corporation. But most of the time, those are season tickets, so they're going to be paid in advance. Otherwise, they're not going to get their season ticket.
You know, it's interesting with baseball, like how everything's going on right now and how some of the players, not with the Cardinals, but with other teams, like how they're not having, the players are having issues with what they want to do with their salaries right now. It's going to be major implications with this league right now.
My son's been filling me in on that, and even though I've heard what some of the pay cuts are, you know, and I'm making numbers up right now, but Joey had said something like, I don't know, 40 million down to 8 million or something. I'm still kind of a little bit shocked, I guess, at that potentially won't be a season because they can't figure something out. I don't know. But yeah, I've heard that too, especially when they're already talking about hockey being able to finish it up.
They already have a plan about how they're going to finish it up. But there was a season where hockey lost an entire season because they couldn't agree on salaries.
Yeah.
And then, of course, we ended up getting a salary cap as a result of that, which was better for the whole league.
Yeah,
but
it could be.
We could potentially see that in baseball.
Yeah, it could actually, and that's going to make me sad because I like listening to baseball in the summer too. So we shall see. And I actually got an update today, sorry for those that don't care about sports, that Iowa State has already said they will not sell more than 50% of their capacity at their stadium if they get to have fans. And that only leaves right now, based on what they've already sold to season ticket holders, 8,000 seats. So there won't be a lot of single tickets, basically, they said, to those games. So they're one Big 12 school already speaking up that what they're doing for their limitations.
I got a question.
Yep.
What is the title of Case B and Case C again? I got deferred revenue cash.
Okay.
And what is B and C again?
B is just going to be cash and account and revenue. That's your easy one. That's walking up. Right, can you see that? You guys do see that, right?
Oh, okay.
Okay. And then down at the bottom, can you see it written on the bottom down here?
Yeah.
Okay.
Gotcha.
All right. So if you got it, I'll go on to the next screen. I just want to make sure I don't take it away from you. Okay. All right. All right. And then on the expense side now, it's called the expense recognition principle, but it's nicknamed the matching principle. And the reason it's nicknamed that is because we want to match revenue with expenses. We want to keep them in the same period so that when we do it together, net income actually makes sense. It doesn't make sense to be recognizing revenue in April and expenses in October. They should be in the same time frame, right? So, there we go. All right, so the first way we have it with expenses, we'd be looking at the fact that we pay for something ahead of time, but we haven't done anything with it yet. So example there is going to be supplies and cash. All right, when we go out and we buy supplies, it's an asset. Then once we use up the supplies, it becomes supplies expense and supplies. So it starts as an asset, and then as we use it up, it becomes an expense. All right, so that's case A. Case B, I'll write it right now before you see it. That's your perfect scenario. I'll show you because that way it matches. That's where we use up an asset and pay for it at the same time, that would be something like, whoops, I guess I got to type the, I'll just leave it here. Electricity expense and cash. All right. It happens as we use it. You get a bill, use it up, pay for it. And then the last one is you have something, but you haven't paid for it yet. So a good example there is advertising expense. You record the expense, but it's an accounts payable. So you ran the ad right now in the month of May. It's May 27th, but you haven't paid for it. And then next month, you take it out of cash. So if you notice, it doesn't matter when you pay the cash. Because if up here you noticed, here I had supplies and cash, but then it was supplies expense and supplies. So, and then this one, if I put it in the same thing, the expense was always at the same time. The expense always is at the same time. I might pay for it ahead of time. I might pay for it at the same time, or I might pay for it after. It doesn't matter. You always recognize the expense when you use it. All right. All right, so